Let's dive right into this explainer and demystify the high-stakes, highly complex mechanics of corporate carve-outs. We're going to look at them through a surprisingly fitting lens today, and that's a relay race. Designing, executing, and actually winning consumer and industrial carve-outs takes a massive amount of coordination. So treating the whole process like a high-performance athletic event is honestly the absolute best way to understand how top-tier companies get this done.
So let's talk about the stakes here, because they are massive. Why even put your organization through the grueling process of a carve-out in the first place? Well, it comes down to a powerful financial concept: multiple arbitrage. Literally every single dollar of EBITDA improvement you generate in that carved-out entity can yield 10 to 20 times that amount in your final deal value, especially when compared to your implementation costs. That is a staggering multiplier, and it's exactly why nailing the mechanics of this race is absolutely crucial.
And that brings us to the core philosophy we're unpacking today. Think about it. Dropping the baton during a corporate handoff destroys immense value. But if you plan carefully, you ensure both entities, the one you're selling and the one you're keeping, cross that finish line even stronger. You can't just casually divest a business unit, cross your fingers and hope for the best. You've got to plan early, lock in your strategy, and execute without a single fumble.
All right, Section 1, the starting blocks, strategy and selection. Let's see how a winning corporate separation is actually built.
Because as you know, a winning team isn't just thrown together on the morning of the big event. Proactive sellers are constantly applying what's known as the best owner test across their entire portfolio. And if they realize, hey, we aren't the best owner for this specific business unit anymore, they don't just jump into a sale. They start preparing an 18 to 24-month optimization runway. This means building up those value creation muscles early, setting up shadow P&Ls during normal business-as-usual operations. You have to get the governance and capability mix right way before you ever announce a deal. If you wait until the decision is made to sell to figure out what you actually have, well, you've basically already lost the race.
Moving right along to Section 2, the strategic dichotomy.
Before you can even pick a specific operational model, you have to make a fundamental strategic choice up front about the race you're actually running. You essentially have two distinct paths here. Are you aiming for an internal separation? Because that means establishing a completely standalone P&L, strictly defining the perimeter, and allocating shared costs so you get true performance transparency internally. Or, on the flip side, are you executing a full divestment to capture balance sheet proceeds? A carve-out doesn't automatically mean a total disposal. Knowing exactly which of those two goals you're chasing dictates absolutely everything else that follows.
Which brings us to Section 3, choosing your race plan. Once your main goal is set, you have to select one of four primary operational structures, your race plans, based on the deal's complexity and your eventual buyer. First up is the business in a box. This is your fully independent, autonomous company ready to go right at initial outreach with zero ongoing seller support required. It's perfect when you have certainty of a public track carve-out, like a known IPO. It's also incredibly favorable in divestiture auctions with multiple private equity buyers because it offers total separation. The catch, though, it comes with a high potential for steep implementation and double running costs pre-close. It is very much the premium, high-effort option.
The second model is the partial standalone. In this setup, the new company, let's just call it Carve Co., operates all its core functions independently, but it isn't totally self-sufficient yet. It still relies on the parent company, RemainCo, for certain infrastructure and support functions. It's a really solid middle ground, balancing independence with shared resource efficiency.
Then we have our third approach, the synthetic standalone. Here, you have a clearly defined perimeter and separately reported financials, but under the hood, it remains completely integrated with the parent company across people, processes, technology, and contracts. This is often heavily favored by sellers who might be facing resource constraints and want to wait for the buyer to actually lead the separation planning. And really quickly, keep a fourth option in mind too, the fully integrated model. That's where literally no physical or systematic separation happens prior to the sale, completely pushing that burden onto the buyer post-close. Let's look a little closer at Section 4, the synthetic advantage. While that synthetic model might sound less complete than a business in a box, it actually hides a secret weapon for keeping your deal perfectly on pace. This brilliantly illustrates the sheer power of data. By building decision-grade synthetic financials directly inside your parent company's ERP system, complete with a separate chart of accounts and profit centers, you create a massive strategic advantage. We aren't talking rough estimates here. We're talking full cost allocations. It acts as a major carve-out enabler.
By providing these live, race-paced numbers before anything physically splits, you grant incredible transparency. And guess what? When buyers actually trust the numbers, bidder confidence skyrockets and they pay higher multiples. Simple as that.
Getting close to the finish line now. Section 5. Maximizing the final exchange. How do we systematically grab that massive 20x multiplier we talked about earlier? Well, it's a clear 3-step progression. Step 1, you open with the Carve Co baseline. You have to ruthlessly strip away all that parent company noise to reveal the carve-out's true initial financials. Step 2 is where the magic happens, right-sizing the operations for a leaner day 1. A lot of times this involves using transitional service agreements or TSAs. But here is the golden rule. Best-in-class sellers treat TSAs as tape, not glue. They are temporary bridges, not permanent structural bindings that bog down the new entity. And finally, step 3 pushes past where most carve-outs stop. You reveal the full potential, fully optimized standalone business to totally maximize that sale value.
And finally, Section 6, flawless execution at the finish line.
This is where the race is definitively won or lost, the final handoff between the parent company and the buyer. A perfect exchange requires incredible discipline. All your financial planning collides here with robust data and rigorously tested day 1 readiness. But listen, it's not just about systems, it's about the people. A flawless handoff demands rock-solid talent retention strategies. You need careful incentivization so your key players don't just jump ship at the last minute. Because if you drop the baton here, maybe by failing to separate a critical system or losing a key executive, months of hard running are just totally lost. But get it right, and both companies keep running at top speed, crossing that line stronger than ever.
So as you look at your own corporate portfolio and review your divestment strategies, I really want you to ask yourself, is your portfolio actually race-ready? Have you done the best owner test? Do you have the precise financial tracking and the strictly defined race plan required to capture that massive 10 to 20x multiplier? Or are you risking a dropped baton before the starting gun even fires? Start building those muscles in your business-as-usual operations right now, because when it comes to the carve-out relay, preparation isn't just important, it's absolutely everything.